Spain lifted the World Cup trophy, earned a record $50 million prize, and then came the tax warning. But before you believe the viral claim that the IRS can simply seize almost the entire award, listen carefully. The United States may tax the American-sourced portion, yet $43.75 million is not the tax bill. That distinction could change the story by tens of millions of dollars. Before we break down the real numbers, subscribe to the channel and turn on notifications. We separate confirmed tax rules from viral headlines so you can understand what happened, what is still uncertain, and what the story could mean beyond football. Spain defeated Argentina 1-0 after extra time in the 2026 World Cup final in New Jersey. Ferran Torres scored the winning goal. Spain became world champion for the second time, and FIFA's official prize schedule awarded the Champions Member Association $50 million. That is the first important detail. FIFA's check goes to the participating National Football Association. It does not automatically deposit $50 million equally into the personal bank accounts of the players. Any bonuses later paid to players, coaches, employees, or contractors can create separate tax questions. The second detail is where the income was earned. The 2026 tournament was jointly hosted by the United States, Mexico, and Canada, but Spain played 7 of its 8 matches in the United States. Its first 2 group matches were in Atlanta, while its third group match was in Guadalajara, Mexico. Spain then played its round of 32 match in Los Angeles, the round of 16 in Dallas, the quarterfinal in Los Angeles, the semifinal in Dallas, and the final in New Jersey. That matters because the tax authorities of the United States, Canada, and Mexico agreed on a reasonable allocation method for tournament prize money. Under that method, the total award is multiplied by the number of matches played in a country and divided by the team's total number of matches. Taxpayers are not legally forced to use this method if another approach better reflects their facts, and using it does not guarantee protection from an audit. However, it gives us a much more responsible starting point than simply applying a tax rate to the full prize. Here is the real-world example. Spain played 7 of 8 matches on American soil. 7 divided by 8 equals 87.5%. Multiply the $50 million prize by 87.5%, and the result is $43.75 million. That is the amount that could be allocated to the United States under the match-based method. The remaining $6.25 million would be associated with the 1 match played in Mexico. Now watch the difference between taxable income and tax. Some headlines have described the IRS as taxing up to $44 million. That wording can easily make viewers believe the government will take $44 million and leave Spain with only about $6 million. But $43.75 million is the possible U.S. allocated income base, not a confirmed $43.75 million tax charge. For certain payments to non-resident foreign athletes or independent contractors, the standard federal withholding can be 30% of the gross U.S. source amount unless a treaty, statutory exemption, or central withholding agreement changes the treatment. If, purely as an illustration, 30% withholding applied to all $43.75 million, the amount withheld would be approximately $13.125 million, not $43.75 million. Spain's association would then have approximately $36.875 million of the $50 million prize before considering Mexican tax, state obligations, player distributions, other costs, possible exemptions, credits, refunds, or a different final federal calculation. Even that $13.125 million figure must not be announced as Spain's confirmed final tax bill. Withholding is money collected in advance. It can be higher or lower than the final liability. A U.S. tax return is normally where the taxpayer reports the relevant income, reconciles the amount already withheld, claims allowed deductions or treaty positions, and requests a refund if too much was collected. Employees can also be subject to different graduated withholding rules rather than the flat rule generally applied to some non-employee payments. There is another major complication. Reports before and during the tournament said participating national associations might be able to apply for federal tax-exempt status for certain tournament earnings. That relief would be at the association level and would not automatically erase the personal tax obligations of players and staff. It is also not enough to say that an exemption exists in theory. The association would have to qualify, apply correctly, and comply with the applicable conditions. Until an official filing or final assessment is made public, no one outside the process should claim to know Spain's exact net amount. The United States and Spain also have an income tax treaty, but the treaty is not a magic no tax card. The treaty specifically allows the United States to tax income earned by Spanish athletes from personal sporting activities performed in America when the compensation exceeds a small threshold. It can also allow income paid through another person or entity to be taxed in the country where the athletic activity occurred. At the same time, the treaty contains special provisions, including possible relief where a visit is substantially supported by public funds, and it provides a system intended to reduce double taxation. Whether any particular provision applies depends on the legal identity of the recipient, the source of the money, the funding arrangement, and the documents filed. Double taxation is one reason this story cannot be reduced to one dramatic percentage. Spain may tax its residents or entities under Spanish law, while the United States may tax income connected to services performed on American soil. The treaty generally allows relief through a credit mechanism so that qualifying U.S. tax paid can be considered in Spain, subject to limits. That does not necessarily make the total tax zero. It is designed to prevent the same income from being fully taxed twice without relief. Then come state taxes, often called jock taxes when they apply to professional athletes. A player can owe tax in a state where he played, trained, or performed services, even though he lives in another country. Spain's American route included Georgia, California, Texas, and New Jersey. Texas does not impose an individual state income tax, but California, Georgia, and New Jersey have their own rules. States may use duty days rather than the federal match count method, and a state does not necessarily follow an international federal tax treaty. That means the federation level prize, a player's bonus, a coach's compensation, club salary allocations, and endorsement income may not all be calculated in the same way. Endorsements are especially important. If a player filmed an advertisement, made a paid appearance, promoted a brand on social media, or received a performance bonus while in the United States, that income may require a separate sourcing analysis. The special three-country consensus was created for FIFA prize money and related compensation. It does not automatically decide the treatment of every commercial deal connected to the tournament. This is not a special punishment invented only because Spain won. Any foreign team earning tournament income from matches in the United States could face American tax exposure. Argentina received the runner-up award, and other national associations received payments based on how far they progressed. Their U.S. allocated shares would depend partly on where their matches were played. American athletes also deal with state-by-state tax allocation when they perform away from home. People may debate whether those rules are fair, but the underlying principle is long-standing. A country or state generally claims the right to tax income connected to work performed inside its borders. There are three practical precautions that matter in a case like this. First, separate the recipients before calculating anything. The National Association, each player, each coach, and every independent contractor may have a different tax residence, employment status, and treaty position. Treating the entire team as one taxpayer is how a viral headline turns a complex calculation into misinformation. Second, document every match, training day, media appearance, and payment. Keep contracts, bonus agreements, travel calendars, hotel dates, payment statements, and records showing where services were performed. The match count method may be reasonable for FIFA prize money, while a time-based duty day calculation may be more appropriate for staff wages or state tax. Without clear records, it becomes much harder to challenge an incorrect allocation or recover excess withholding. Third, complete the tax documentation before the money is distributed. A foreign recipient may need a U.S. taxpayer identification number and the correct version of Form W-8, Form 8233, or other documentation, depending on the payment and treaty claim. Some athletes or performers may seek a central withholding agreement, so withholding is based more closely on estimated net income rather than a flat percentage of gross receipts. These are specialist decisions and should be handled by qualified cross-border tax professionals, not by a social media advisor promising a secret loophole. Now let us address a missing or reduced payment. If a player expects a tournament bonus but receives less than the amount reported in the media, that does not automatically mean FIFA, the federation, or the bank stole the money. The public prize is not necessarily the player's contractual bonus, and tax may have been withheld before payment. The recipient should request an official payment statement, confirm the bonus agreement, check the recipient name and bank details, and obtain any Form 1042-S or other tax document showing U.S. source income and withholding. If too much federal tax was withheld, filing the correct U.S. return is generally how the recipient reconciles the account and claims a possible refund. But a genuine delay should not be ignored. A wrong taxpayer identification number, missing treaty form, mismatched legal name, incomplete bank information, or compliance review can hold up a payment or later refund. The recipient should contact the Federation's verified finance department, the authorized withholding agent, or a licensed tax advisor. Do not rely on a direct message from a new social media account claiming it can release the World Cup money. This story will attract scammers because it combines famous players, enormous prizes, international transfers, and the IRS. A criminal may impersonate FIFA, the Spanish Federation, a bank, a tax agent, or the IRS and demand an unlock fee. Never send money to a personal account, buy gift cards, transfer cryptocurrency, or reveal passport, bank login, or taxpayer identification information because of an urgent message. The IRS does not demand tax payment through gift cards, and legitimate tax payments should be made only through verified official channels. Independently confirm the sender using contact information already held by the recipient, not the phone number or link included in the suspicious message. So here is the short recap. Spain earned a confirmed $50 million Champions Prize after beating Argentina. Because 7 of Spain's 8 matches were played in the United States, the reasonable match-based method could allocate $43.75 million of the prize to U.S. sources. That does not mean the IRS takes $43.75 million. A possible 30% gross withholding on that allocated amount would be about $13.125 million. But even that is only an illustration, not Spain's confirmed final bill. Association-level exemptions, the U.S., Spain treaty, state taxes, player bonuses, employment classifications, credits, and later tax returns can all change the result. The trophy belongs to Spain. The $50 million prize is real. The American tax exposure is also real. What is not yet public is the exact final amount that the Federation and individual players will ultimately keep after every filing, exemption, credit, and refund. If you think host countries should tax international teams on prize money earned within their borders, comment fair. If you believe FIFA tournament prizes should be protected from host country tax, comment exempt. Like the video, subscribe to the channel, and share this with someone who saw the $44 million headline and thought it was the tax bill.